Maya, what do you think about this everything rally? It's pretty impressive looking at stocks, but also looking at bonds where negative yields don't seem to scare investors away.
Yes, I mean, I suppose it's within bonds. It's not just what's happening at the longer end, but also what's happening to the curve overall. And short-end rates across the major markets today are expected to be lower than they are today for 2, 3, 5, even 10 years, depending on where you look. And in both Germany and indeed the UK, those interest rates are also expected to be below inflation for at least 10 years, as suggested by negative inflation-linked yields. And so you might argue, well, that sort of situation is not particularly constructive, or the message isn't particularly constructive. It's rather bearish. By contrast, of course, equities have rallied quite smartly and are coming out for nice, strong double-digit year-to-date gains. And I think this is sort of, if you like, quote-unquote, the cognitive dissonance folks speak about. And while I can see that it's difficult to reconcile those two on the face of it, I do think that there is a credible path, if you like, for both of those to occur in tandem. And that credible path, if you like, is a very narrow one. It's one whereby central banks, the Fed, the ECB, are able to lower interest rates such that they can avert a recession. Certainly, recession isn't part of our core forecast anywhere this year or next year. But they are not going to be so successful that they raise inflation and inflation expectations further out, and therefore need to raise interest rates. So it's that narrow sort of narrow path, if you like, that I think is consistent with both bond markets pricing in lower policy and equity markets quite liking it, because they don't see policy tightening anytime soon. In other words, a relatively constructive environment for equity markets, where you have sort of weak middling growth, not much inflation, and central banks lowering interest rates.
What do you make of the rally in stocks then, Maya, when you think about the way that the market has been evolving structurally? Because I know that you pointed out in the past that, maybe it's the wisdom of crowds in the equity markets, the assessment of all of those earnings reports and prospects of individual companies added together adds up to this level of optimism. But in an age where we're seeing a lot of passive funds, a lot of index trackers, does that still apply? Are we still seeing the sum of the past being reflected in this move higher in equities, or is it something less insightful that this rally in equities is telling us?
Well, I think if we look at what equities are telling us under the hood, if you like, what we're seeing with earnings expectations, what we're seeing with companies' guidance, those things are not moving in a positive direction. We discussed earlier on in the show how earnings expectations, for example, for this year for global equities have come down to roughly flat from being 10% about a year ago. And so, I think to our minds, it's the combination we just discussed is okay for now, but we are sufficiently concerned, if you like, of a misstep in either direction, that we've lowered our equity allocations much more towards neutral rather than a favorable allocation that we had previously, and are really being mindful of how those earnings evolve. Now, of course, we're very early in the earnings season, about a third the way through in the US. So far, so good. Earnings have been reasonable. But I think this earnings season will be a good and an important litmus test, if you like, for some of those expectations.